This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
Okay, welcome to the show. This show I'd like to call Why Stocks Are the Safest Place to Invest Your Money. I used a very strong word, safest, which Andy usually struggles with. But,
I always struggle with that one.
But I just did some reading, and Andy, I know you did some reading too, and it really convinced me that the stock market is almost set up so it can never fail. And again, too strong a word to say never.
Holy cow. I'm glad we're going to have a talk today.
Yeah, I know. You're going to straighten me out. But so this article is, I can't remember this guy's first or last name, but it was Lacey somebody. Do you remember his name? I think you read it too. And this guy, he made a really strong point that two points. The Federal Reserve will always be pumping money into the economy through banks and the stock market. And so because of that, the stock markets will always go up. And they're the safest place to put your money, knowing that the largest institution in the world, the one that controls the money, that has all the power, believes they need to keep propping that up. And the second point is that's the only way they can do it, because the banks don't disseminate the money they give them. And so there's only one way to put the money, and that's in the stock market. And treasury and bonds, sorry. So Andy, do you agree or disagree with that article?
I disagree. I think the title, instead of the stock market's the safest place to your money, I think we should turn it into a question is the stock market a safe place to put your money? I think that's a better way to look at it, because, let's just start with the beginning.
Okay.
So if one of the things I study, and it's funny because my business partner who is in charge of our education arm I said to him a few months ago, I said, I want to do a class on monetary policy. And he said, no one's going to buy that class. I go, it doesn't matter. I want to give it away for free. He goes, it won't matter. No one wants to learn about it, because when they hear the word monetary policy, they want to kill themselves, right?
Hey, I'm the same way. Like, I hear that word, you know what?
I don't want anything to do with it. Yeah.
Not only do I not want anything to do with it, it doesn't have anything to do with me, because now you're talking about crazy rich people, government stuff I don't understand. It has nothing.
That's why. And so here's the thing: if it doesn't have anything to do with you, then why would I do the class?
Yeah, no, I get it. But that's my first response when you
that's
say
the first reaction, right?
Like, shut up, I don't want to care.
And it's so dangerous, isn't it? It's so dangerous. What if I said I was going to show you the most important rules of money? If you wanted to be rich, and I said, I'm going to show you the rules of money, would that be interested to you?
Yeah, maybe you should call it.
Hey, what's another word for rules that starts with a P?
I'm going to guess you're going with policy here.
And what's another rule for money that starts with an M and a Y? So monetary policy means the rules for our money. And if you're going to play the game, you need to know the rules.
I'm not going to say it for you.
And the rules of our money have changed, tremendously changed. And the rules and what the Fed can do and can't do is changing all the time, and it's expanding, not contracting. So let's
wait. You just said that the rules are changing all the time. So you want to teach the rules, you have to be updating your rules all the time.
You really do, which is
so what's the point of learning them? They're going to change as soon as I figure it out.
Which is why the advice culture is so scary, right? Because today's advice that might be good is terrible tomorrow. So a person, and it's really about whether they want to work at it. Like, I'm not here to convince anyone to learn this. If someone says, I don't want to learn it, it's all right. But understand that person says, I'm willing to take on the consequences of financial ignorance. Okay, that's fine. But I put it out there.
Boil this down. You're going to tell me that I need to learn this because it actually.
No.
Wait. It actually affects me as an individual.
I'm not going to tell anyone they learn anything. They don't have to learn anything they want. I just don't take that posture. Does it affect you? Yep. If you go to the grocery store, it affects you. If you want to invest, it affects you. If you have a paycheck, it affects you. If you have a mortgage, it affects you. If you pay interest of any kind, it affects you. And the danger is people say, well, they're not, there is a mindset of wealth that's important, because wealth is about hard freaking work, is what it is. The rich don't work for money, they work to learn. The reason people like to work for money is because it's easier than working to learn. Working for money doesn't cause as much headache as working to learn, because I got to struggle through stuff. I got to learn stuff, makes my head hurt, blah, blah, blah. But that's why Buffett is who he is. It's not because he was genetically programmed to be a zillionaire. Guy studies every day. So let's start with this conversation with monetary policy and Ben Bernanke. So there was a term in the subprime meltdown of 2007 and 2008, right around in there. Ben Bernanke decided to print a whole bunch of money and change the rules. So the rules were the Fed could buy treasury bonds. They could print money by treasury bonds. The change in the rule says we can print money and we can buy collateralized debt obligations, or MBSs, mortgage-backed securities. So that's a major change. Then rather than buying something that was backed by the full faith and credit of the United States, a treasury bond, they're not going to buy private stuff that are really toxic. So we had this TARP program, the toxic asset protection, whatever it was. So that's a pretty big change. Well, all of a sudden people said, wait a minute. If we can screw up majorly, if we can make bad loans to people that can't pay them back, and we can take those and package them and then sell them on Wall Street for Bear Stearns, or more importantly, Goldman, if we can do that, then why should we be responsible capitalists? Because that's not capitalism. Capitalism means you screw up, you freaking fail. The irony of that is that Evergrande is in communist China, and China is acting, they'll probably buckle, but they're acting like, no, we're going to let you freaking fail.
Okay, wait, before we go to China.
So there's no Bernanke put. Now put option.
Wait. You just said they bailed out the real estate, right?
They bailed out the banks.
Okay. Who made bad real estate loans?
Really bad loans.
Now, how horrible has the real estate market gone since then?
Been fantastic.
It's been fantastic.
Yeah. Well, it hurt until they bailed it out.
The Federal Reserve.
A lot of people lost their butt.
And they insured it, basically.
Yeah. And so they call it the Bernanke put. Now, a put option is a guarantee that allows you to sell your stuff if it goes bad, which is exactly what the Fed did. We'll let you sell our stuff to us. The Fed will buy it if it goes bad. And so there's this term that came out called the Bernanke put. Then it turned into the Yellen put. Now it turns into the Powell put. And I just call it the Fed put. Because what you're really saying at the top of the show is, it's like, well, why not invest with reckless abandon in financial institutions like banks and stocks? Because no matter how bad things get and how detached from fundamentals they get, they're just going to print more money and prop it up forever.
And so that is exactly what I'm saying, because like you just said, the real estate market, we have a history of seeing this and it's worked out great.
Well, now let me
I feel like I'm
playing the devil's advocate there. We have a very, very short history of seeing this.
Okay.
We don't have 150 years of seeing this. We have about 12 years of seeing this. And there are ramifications. People point to Japan and say, well, their debt to GDP is, 250 for 20 years. Well, yeah, they have 100-year mortgages, and to create a legacy for kids over there is very difficult to do. And even though it's a patriarchal culture.
Okay, but we've had this conversation before too. I go to Japan. They are living the same quality life I am. And so it doesn't look like, at least from the outside, it doesn't look like they are getting any negative benefits, because
I will tell you this. A person that has a 100-year mortgage and a person that has a 30-year mortgage looks the same. Their financial statement doesn't. The legacy they live to their kids certainly doesn't. And their relationship with the bank is much different.
But their cars are the same. The food they eat's the same. They still live in a nice house.
For now.
They still have medical.
Yeah. So, but here's the real question is, we have a history. Well, we had a history for a long time that there'd never be a 4-minute mile broken. We had a history a long time where you'd build a building and they wouldn't fly planes into it. We had a history for a long time where we had gold backing our dollar. We had a history. And so I don't buy, I remember that Robert Kiyosaki called me one time and he said, hey, someone's pitching me on a Rich Dad ETF. He says, what do you think? I said, run for your life. And I said, he goes, will you talk to these guys? I says, yeah, have them call me. So these guys, basically they saw Rich Dad as a huge brand. And they said, look, if we have a Rich Dad ETF, look how many people will buy it. As many people as bought the book will buy the ETF. And their whole purpose was just to make money. That was it. It wasn't to bring any value. I said, well, what trading system do you going to use to make this ETF profitable? They go, we don't care. I said, well, what one do you want? He goes, let's use yours. You're the Rich Dad advisor. I said, how do you know mine will work? He says, oh, we'll back test it. And right then I knew I was talking to idiots. You back testing? Let me tell you something. There was a long time where we didn't have cryptocurrencies. There was a long time where we didn't have cell phones, a long time where we didn't have the internet, a long time. Things change. So to say, oh, we have a 10-year history of the Bernanke put working out, or I live the same in Japan. As a risk manager, I'm always thinking about the new high, the new low, the big, well, this is the biggest crash we've ever had in history. We'll never have that again. No, we will. Every record in the NBA is going to be broken. Someone's going to beat Stockton's assist and steals record someday. It's going to happen. Someone is going to, like every Olympics, there's a new world record set every time. I don't think we've ever had Olympics where all the sports fell short of someone making a new world record. It's going to happen. So I don't get very excited about people pointing to the past saying, well, it never happened before, right? No, it's the future I care about. It's the future, right? Up until someone's unfaithful to their wife, it never happened before. And then it happens. So really, really important to say, what can I go on beyond history? Well, if there's a Bernanke put, we have to ask the strength of that source. And the question is simply this: can a Ponzi scheme work in perpetuity? That is the question. Is there such thing a way for a Ponzi scheme to go into perpetuity? For Bernie Madoff, the answer was no. For Ponzi himself, hence the name, the answer was no. Is that it's very, very difficult to borrow from one source to pay off the old source in perpetuity. In the game of basketball, I teach my kids something called fundamentals. The word fundamental denotes things that are vital to a process being successful. If I go to the doctor, they're going to have certain fundamental things they check: BMI, cholesterol, blood pressure, heart rate, vital signs of vitality. Vital means they got to be there. If I take those fundamentals away, they can punch adrenaline in my heart and say, well, he's been alive for the last 5 minutes. Well, he's kept him alive for 10 minutes. Why not in perpetuity? And I will just tell you this, that and I could be totally wrong, by the way, because I'm a student, not an expert. I always position myself that way because it's safer and it's true. I'm a student, not an expert. But in my opinion, a fundamental to a business is to provide value to a customer for it to work. If you're not providing value to a customer, it doesn't work. And so the way you know whether you're doing that is by sales. If people are paying rent, because they appreciate staying in your house. If they leave, you weren't giving them value. If people are buying Coca-Cola or Dairy Queen or Fruit Loom underwear or Heinz ketchup, you know you were giving them value for their dollar. The problem is the prices of these companies and these real estate projects as they grow are not coming because they're attractive business earning money. They're coming because they're the least. Like my wife just took second place in a bodybuilding contest. I think she should have won it, right? But they were, anyone that's there, just because there's 6 people there, maybe in her stage class, doesn't mean all of them are fit. And so you might wind up with one with all unfit people and you have someone 500 pounds win it because everyone else was 700, 800, 900 pounds, right? On the scale. And so the question is it the safest place? I don't think it is.
Wait, I don't know how you can say that, because then you have to identify a safer place.
No, you can have the whole city burn. If there's an earthquake in San Francisco, you could say, look, it's just, you don't want to be in San Francisco, right? Find me the safest building in San Francisco. They could all tumble with a strong enough earthquake. That's called risk. And you take risk when you invest, and education is to manage that risk. My question is this. You have to show me, someone has to show me why, and Stephanie Kelton has tried, and Warren Mosley has tried, but I do not see a Ponzi scheme working in perpetuity before someday the gravity of those fundamental things that matter, serving people, matters. And eventually that gravity, in my opinion, will take hold. And the stock market will come back. If you look at the charts, you want to talk about history? When you had the crash of 07, 08, where did the stock market fall to?
I don't know.
Fell right back down to about $15 per PE, 15 PE, which is historically where the mean has been for the last 120 years. That's been about where people see value. Right now, it's almost 40. So you're telling me, why am I paying $40 for the same dollar that I used to pay $15 to get in terms of giving value to customers?
Okay, but I feel you changed the words we're using. You're saying, is our stocks impossible to fail? I'm not saying that. I'm saying, are they the safest place?
You know, the safest place, it really depends on whether you have deflation or inflation, because you can't, stagflation is always a question to talk about, but generally you have inflation or deflation. If you have inflation, stocks are a fantastic place to be. If you have deflation, no, not so much. Then they're not a safe place.
Because inflation makes prices of things go up.
Yeah, I mean, if you want to be safe during deflation, cash is your safest place. But if you have inflation, cash is your least safe place, and debt is your safest place.
And I'm going to give you a quick plug. That's actually why you created that free course, the macroeconomics course, which you can get access to in the show notes, people.
Yeah, it's not an easy course. Look, it's not like some freebie I throw out there, like a sample at Costco for people to try necessarily. It's a whole meal. Okay. If I want to do a freebie, I'd teach for a half hour, right? This is like 5-6 hours of training. So when you go in the voting booth, you do it better. Not that I care where you vote for. when you consume stuff at the grocery store, that connective tissue that you were talking about earlier about how does this affect me?
Yeah.
Take that class and you'll walk out of there saying, okay, this is important for me to continue to study and keep my pulse on.
So I'll tell you myself, I actually study this quite a bit. And I study it because I have limited resources and I need to make my best guess. Is it going to go inflation or deflation? And then I invest based on the very limited knowledge I have, which is why I keep trying to learn more, because it does change the complete way I invest and the direction I invest.
The important thing is, we've had this conversation before about limited resources. It really begins with a person's mind. It really does. It begins with a person's mind and their beliefs.
That's very limited right there for me.
It's about their beliefs, right? I mean, what do you believe you can achieve? What do you believe you can and can't do? That's Blair Singer's department, probably more than mine. But I will tell you that being prepared for both. I don't like the idea of guessing my best guess. I obviously have to buy something. I have to make a guess. But I also very much believe in all four pillars, the fourth being risk management, because I'm just unwilling. Look, everyone has their choice. You can either say, I don't care, I'm going to work at a job the rest of my life. If I lose one, I'll find another one, figure it out. That's a life you can choose. A person could choose that life. Other people are going to say, look, I'm going to put all my bet here. If it works out, it's going to be awesome. And if it doesn't, it's going to suck. That sounds like Vegas to me. The third one is the one I attempt to try to do, which is the hardest of the three. It's hardest emotionally. It's hardest mentally. It takes a context. Is I'm going to make my best guess, like you said, but I'm going to create plan B and plan C as best I can because I'm wrong so much. And I've been wrong so many times that I've just learned that little Boy Scout idea of be prepared has to be a bigger idea than I'm taking my best guess and going with it, because your best guess can be wrong. And what's really sucks is it can wipe you out in fluctuation. You can plan for inflation And one bout of deflation can wipe you out and set you years behind. You can plan for deflation and one bout of inflation. The fact is, in your life, you'll probably have both several times. And so it's really hard to just say, I'm going to go here and stick with it because this is a fluid environment. It's like playing a basketball game. You know, sometimes you're up, sometimes you're down, sometimes you see a zone, sometimes you see a man. You know, sometimes the refs are good, sometimes they let you play. It's just very fluid every time you get into the game. And it really comes down to two things: temperament, how temperament, your temper is. If you have a bad temper, that's rough, makes life hard. And then number two is your education, but you got to have both. You can't have a bad temperament. No amount of education can compensate for bad temperament. And no amount of good temperament can compensate for ignorance. You got to have both, in my opinion.
Okay. I want to take you back though. So the statement early on was the stock market is the safest place because it's basically backed by the Federal Reserve, which in my opinion is the most powerful organization in the world. And even the Federal Reserve has said that they aim for inflation.
Jerome Powell was testifying with Janet Yellen to the House committee the last couple of days. And, he said it. He says, look, we've overshot inflation. And they're saying, and then they tried to pin him down. They go, well, you say it's transitory. How long is transitory? He says, well, I don't know. And then they says, well, if you don't know, how can you say it's transitory? You know, if you say it's short term, how short is the term? He goes, well, I don't know. So they kind of tried to pin him down and he dodged, and that's just politics.
Yeah. But they're the ones that make the money, and we know how they spend the money, which is in the stock market.
They buy treasuries.
They've also publicly said they want to keep some level of inflation always going.
2% is what they want.
Yep.
So the question is, can they do that? And right now they're failing. They failed.
I don't know. They're keeping inflation going great.
No. Look, they have failed to get 2% because if the engine gets too hot, it overheats. If it gets too cold, it won't start. They haven't hit it yet. In his tenure, he hasn't hit it. He's been either short of it or he's overextended. They either overshoot it to just get right there and manage this thing perfectly. Oh man, it's nuts. So my confidence in the Federal Reserve, you don't want to fight the Fed, but I don't know that I trust them with my family, because I just don't think a Ponzi scheme works in perpetuity. I've never seen it work. Maybe it can work. Look, Bernie Madoff kept it going for a lot of years, right? Well, his other clients are doing okay. I mean, they've been doing fine, but when the house of cards comes down, that history is erased. It doesn't matter what happened. So I would just say, as I always do, these are perilous times, unparalleled and perilous. I'm going to rename the show at the end. The show is the stock market's the safest place to put money. That's a context that's incorrect, because it's a context that believes the asset class is the key to your success rather than you. I've been saying this a lot lately, hoping that when I say it, it resonates in people's hearts. I'll say it here and see if it works. Your movement towards your goals, whether you're successful or not, will probably be determined by what you learn in terms of your personal development in these skills. In other words, your investing goals are more likely to be achieved because of some type of personal development in terms of learning and behavior and discipline and temperament. An improvement in myself is probably the safest thing. Look, is the stock market, when you say the stock market is safe, we are taking out the most important element. So let me take a couple of examples. Let's take three. Let's take my mom, you, and Warren Buffett. Okay, all three of you go on the stock market. Is it safe? I'm
gonna go with no.
Let's you and I trade options this month. Let's make all of our income come from options. I have to do it and you have to do it. Ready, go. Is it safe for us?
Yeah, I'm gonna go with yeah.
Okay, let's do it.
I know your strategy for it.
Let's do it.
You taught me. I'm gonna put options on a fundamentally strong.
What about my mom?
Well, okay, your mom's probably not watching the show.
My mom's definitely not watching this show. I
So-
can guarantee you that I can even curse. I can even say like, damn it, because she hates that. She'll never see it. So
no offense. Let's forget your mom and let's talk about the people watching the show.
But really, when you think about it, what's the point? What do you think the point I was trying to make was?
Oh, I get it. You have to develop yourself. You also talked about your temperament as well as your education.
Yeah.
And that's why they're
So
listening and watching the show.
So the point is the safety found in the stock market or in the real estate market or in cash, or is the safety found in my temperament, my development, my skills? So the safest place, I think the safest place to be as an investor right now is an area of intelligence, smarts. That's and temperament. That's where the safety is. It's not about
obviously I'm going to agree with that, but part of the studying, it does guide you to a direction. And like I'm studying to find a direction. So my personal development has led me to, hey, the stock market's that's pretty safe.
Until it isn't.
But at some point you take your education, your knowledge, and you take action.
Yeah. When people ask me about investing in the stock market, I'll tell you how to make it safe. Learn 4 things. Learn fundamentals, learn how to analyze a company, learn technicals, learn how to look at a stock chart, learn cash flow and how to pull money out of it, which is how you position yourself. And here's the big one, learn risk management, because then when you're wrong, you are safe. But without that 4th one, the 3rd help you do what you want to do is find that direction to go to. I have to too. Yeah. That 4th one is the most important one, because what if you're wrong? Because I've been wrong before, and you and I will probably both be wrong again.
I'm a parent. I'm wrong every day.
So position sizing, insurance, put option protection, all of those types of things. Delta hedging in my case. I don't trust the Federal Reserve in perpetuity. I just don't.
That's fair. And in fairness, you teach all 4 of those pillars, like you said. And I've taken your course, and it's phenomenal.
That's where the safety
a little here, but
comes from what I know about delta hedging, what I know about position sizing, what I know about protective puts. Those are the things. What I know about sector rotations. That's where the safety comes. It's not the stock market safe. That's like saying my house is safe. Hey, look, I've lived in a house since I moved out of my home. I've never had a home burn down on me in 53 years of life. So why should I expect the home to burn down? It's been working for 53 years. Why should I buy insurance? What makes my home safe is the insurance, not that it's not impenetrable to burning down. That's how you make the stock market safe, is you insure it.
Okay, two things. One, everybody, and Andy hates this. You can get his 4 pillars cash flow class. If you look in the show notes, there's links there. Second, this has been my whole argument with you. I'm saying the Federal Reserve actions are the insurance.
And if the insurance company fails?
Just like with your house.
So if my house burns down and Allstate is bankrupt and they don't have a check to send me,
you still lost.
So was my house safe? Maybe it was the safest.
The safest is the word.
I guess the question is, so I'm going to invite you to take that monetary course and look at the balance sheet, because the Fed's balance sheet has grown from 1 trillion to 1 trillion to 4 trillion, and then another 4 trillion in 1 year, and they want to do another 7 this year. So in a balance sheet, if Allstate's liabilities grew exponentially like that, I'm raising my eyebrows saying, wow, guys, the only way you can keep doing this is printing more, and you're going to say inflation is transitory. I mean, I don't know how many hundreds of percents that is to go from 1 to, it's over 1,000%. We're not going to have any inflation problems. If we don't, beware, because that means the deflationary pressure is overwhelming. It means the amount of insulin we need to keep that diabetic alive, it's certainly not healthy.
Right.
It's just medicine. So you're right, Greg. Let me play your advocate. Look, you are right that there are many people who are investing heavily in the stock market because they feel the bailout was there before, and it's not capitalism to let things not to let them fail. It started with LTCM, long-term capital management. You've talked to Jim Rickard, so have I. And Jim about fell out of his chair when he went to the Fed and said, look, we're going to fail. That's going to domino the whole Wall Street. So good luck. The Fed said, oh, I guess we better bail them out. And sure enough, they didn't bail out Bear Stearns and Lehman because no one liked them, but they bailed out the ones that needed to be. And they did it. And there looks like they're trying to do it again. If you look at the Fed's balance sheet in 2019, I show you this in my class. I show you the day they changed. They, rather than trying to unwind it, the whole thing was about unwinding that, going from $1 billion to from $1 trillion to $4 trillion. They're going to unwind it. Right before COVID hit, they said, "No, I don't think we're going to unwind it. I think this is the new standard. We're going to wind it up." So instead of trying to get out of the Ponzi scheme, they said, "No, we're going to embrace the Ponzi scheme." In my opinion, it's just an opinion. I could be dead wrong. I just think fundamentally, you got to give value to have your business grow and be profitable. And right now we're detached from that. We're just buying businesses with, printed cash, basically.
Yes. So I'll say this for you, just to make you smile here. Obviously, fundamentals are by far the better strategy.
I hope so. I mean,
how can they not? Because
good news is
they can benefit from both.
There's still some good values out there. I mean, I was looking with one of my business partners in our mentor club and addressing this very thing with the stock market all-time highs. Is there any value left? And we found some good value. I feel.
Yeah, why not? You get the value of the fundamental, the fundamentals, plus you get the value of the Federal Reserve. It's a double win. And if the Federal Reserve fails, you still got your other win. So
hopefully if the Federal Reserve fails, we're prepared for hyperinflation or massive, maybe not hyper, but significant, like double-digit inflation. And hopefully we're prepared for double-digit deflation, that we could have brutal prices drop, and then cash would be. Look, Warren Buffett has $140 billion in cash. Apple has a ton of cash sitting in Ireland that they don't want to pay taxes on. There are some big people that are in cash, and I think Buffett keeps. I don't know Buffett, but I think he keeps cash around just in case there's deflation. He wants to pounce and get a bargain, because in deflation, there's a quote by Charlie Munger on CNBC about this very thing we're talking about this printing and this stuff. And Charlie Munger said, if they continue to do this, it winds up looking something like Venezuela. That's not me. That's Charlie Munger.
Yeah.
Been around longer than me.
I'm not arguing it'll work. I'm arguing that right now it's a great insurance package. But Andy, we do got to end the show.
Great conversation.
Yeah, obviously. Thank you so much. And everybody, I got the show notes and get more Andy Tanner, but seriously, thank you.
I love it.
I do truly agree with what you're saying. I just wanted to throw some curveballs at you.
It's your job but intelligence exists when we see both sides of the coin at the edge. There's three sides. And it's such an important discussion to have, because the Powell put is a thing and people believe in it. And it's just, okay, if you believe in the Powell put, you got to believe in Powell.
Yep, fair enough.
Thanks,
all right, Andy. Thanks a lot. Yeah, bye.